All right, hey traders, this is Christian from Tribeca Trade Group, and this is your end of day recap for Thursday, December 13th. We have one more day of the week to go. We'll see how it goes, but man, it's been a rough week. I would say, in terms of how we've started every day this week, we have not been able to hold. So, what are we at? Thursday, Wednesday, Tuesday. I guess Monday was a little bit different, but man, it has been a tough going, I would say, in this market. So I've got a couple things to go through, but I'll start with the S&P chart, and this is S&P futures, not SPY. But the one thing that I'm concentrated on is we had 2 days. I'll talk a little bit about the price action, how bad that's been, but bottom line is I would like, to get more bullish about the market. I would like to see S&P get above 2670. This is the December value area. Notice that we've basically been, we dropped out of value back on the 7th and have not been able to get back in after this day. This was what, last Friday, I believe? Yeah, so we have not been able to kind of retake that, and every time that we try to bounce, it's been kind of wiped out. So here's what we did today. I've been doing this on a day-to-day basis because I think it reveals a lot. It's not something that I regularly do, but percentage change from the open, because I think it's important. In bear markets, what happens is sometimes futures get bid up into the open, and that can sometimes be the high of the day, like we saw earlier in the day, and then things sell off. So what I like to do is to see what actually increased from the open versus what decreased. And you could see that there's a pretty easy theme that's in these names that were up over 0.5%. And again, this is not their overall performance. So for example, it's actually pretty close, some things. XLU was up 87 basis points and it finished, it was up 87 basis points today, but from the opening print, it was up 80 basis points. But you could see here there is a pretty general theme. Anything that gained from the open at least 0.5%. We're all, besides XLE, which I'll get to oil in a minute, because I think that was probably one of the most interesting things that happened to the upside today. But utilities, gold miners, REITs, staples, these are defensive. These are very all bear market type areas of the market. And then if you look to see what names really sold off, I mean, look at the banks again. I've got a couple different banking ETFs in here. I've got KBE, which is all banks. And I've got KRE, which is regional banks. Look at what is happening to these banks. So really messed up, I would say. And then also, besides this, transports, XLB, as in boy materials, which we've seen some put buying the last couple days. Not today, but last few days. And I think I mentioned that in yesterday's video. We also had the FANG stocks. They gave back. They sold off. They were, right from the open, basically. They were down, ended up down 1.2%. Chinese internet's also not so good, even though China continues to go up, has been going up the last 2 nights and closing just fine in their market. The Chinese internet ETF, a lot of names are listed here in the U.S., down 1.4%. All right, so this is pretty tough stuff. We'll look at a couple other charts. That's the S&P. Really, I tend to look at IWM a lot, the small caps. There is a heavy amount of financials in here. About 10% are banks in this, so that is weighing on them. But we're very close to, again, taking out this level. So these are not good things. So why do I go over all this? And I'm going to talk a little bit about what I think is part of the reason. I tweeted this out earlier about hedge fund liquidation, which is going on. Let's look at the Qs too. Let's just keep going through a couple different indices, a couple different charts. The Qs are still hanging in there, but I think they look vulnerable to me. I mean, it's tough to really say. I mean, that's basically me using my judgment. I would watch that bottom of value. That's really, we're hanging right around this line that I've got drawn. So either we're going to be able to break out or break back up, or we're going to break down. 163.16 is the level of support to watch. And then, of course, you've got the recent lows that are going on in the Qs. But I think that's important to watch. Let me talk a little bit about the sectors today, and then I'll talk about hedge funds, which I think is a big part of the sell-off. But here's the worst of the worst, which is your banks. Your regional banks are getting absolutely smoked. And if you go to the IWM, and I know there's that overlap there, but regional banks are a good. I've talked about how I've not been bullish in the banks in a long time, and I've talked about how they're losing on a lot of fronts. They don't make the same amount of money. People just don't want to work there, me included. I used to work for Bank of America. It's tough, right? It's a tougher environment. All their margins are much more narrow, the way that they make money. But clearly, this is, showing some signs of weakness. Remember as well that I know some people, I think, from my experience, I do look at economic indicators that come out, but really it's in the price. The price will tell you before the economics turn bad. I've learned that in my experience trading is that price knows ahead of time before the bad news is actually out there. So this is not painting a very good picture to see this. And you can look at this is regional banks, but it's the same story if you look at KBE. There's not much difference. This is all banks. If you want to see the KBX index, the BKX index, that's actually KBWB. KBWB. There is an ETF that tracks that. So this is your big money center banks. And you can see this is not going well, right? So keep this in mind, right? We've seen some call buying in the banks. The CNBC channel has the halftime show, and they've been pumping option activity in the banks. You kind of have to use your I've said this over and over about option activity. It's really, they should be, when they point out this option flow and they get all excited about these guys scrambled into Citigroup calls, they should really be putting a footnote rather than getting people all excited. They should be saying, really, they don't know who the buyer is of those calls. They don't know the context of their portfolio. They don't know if they're hedging a short by buying calls. They have no idea. So they keep pumping this stuff. If you went into more, I put on a small position of, I'll confess, I put on a small position of Morgan Stanley. I went over that in last night's video, and I jumped out of it today. This just does not look like a healthy place for me to take a position. So I was looking for a quick bounce. I did not get it, and I'm out. I think I lost $250 on that trade, over and done with. But I say this, and they are oversold. Maybe they do bounce, but I don't know. They should be giving this, if they're going to talk about option flow, they should be talking about how many times their trades don't work. So again, I say this and watch they rally tomorrow, but I just don't think they're doing, by coming on CNBC and pumping up a couple names, like they did the other day in Apple. I don't think they're doing the investment community, especially on the retail side, any favors by getting everybody all excited about call activity when they don't know anything really, other than just seeing a part of a piece of a puzzle. All right, so I went off on that. Transports, also, taking out the October lows. So what's the message from this? Why, what's the importance of this? Is it that you want to start shorting things? Is it, it's basically for me why I'm looking at all these things and all these things that are crumbling, moving down. It just tells me to be very cognizant of risk. And this is not an environment for me to put a lot of money to work. I did that a little bit yesterday, and a couple of the trades that I put on they did not work, right? So I have to go back to what I've been doing very well and just keeping a position that is very, very lean. Not wanting to hold a lot of positions. The opportunity is just not here. So what's one of the causes for this? I think anyway, which the causes are kind of, they shouldn't matter all that much. But one of the things that I said is, I continue to see hedge funds, I pay for Bloomberg. And one of the things that I see is, not every day, but every couple of days, I see a different hedge fund liquidating. So what does that mean, right? So if a hedge fund goes out of business, or they have so many redemptions that they've got to close shop, and it's funny because, so I tweeted this out. This was a good example. This is a good follow, by the way. I like these guys, HedgeMine, right? They were talking about an estimated 174 hedge funds were liquidated in the third quarter globally, right? And they named a couple here, which are pretty reputable. Highfields. I used to execute some of their trades back in the day when I was at Merrill Lynch. Eaton Park. It's another very reputable name. Leon Cooperman, even said that he was turning his hedge fund into a family office. He said that back last year. But so what this means, right? I know this is it should be common sense, but when a hedge fund does this, they have to, if they're owning equities, they have to sell the equities, right? When a hedge fund liquidates, they've got to liquidate their portfolio. So there's people like this that are on the internet, and I'm calling this guy out. I don't know who he is. But this should be alarming to the investment public and traders in general. Index funds are the next segment that will stop working. Since the algos and high-frequency games game the system, they took out the mutual funds, hedge funds. This is bullshit. I mean, I know everybody wants to fault the algos. It's just business. So a hedge fund closing because they have to meet investors' redemptions, that has nothing to do with the index world, whatever this guy said, right? It's not algo generated. It's just the fact that they have to sell because they have to. So that is going on in a lot of places, I think, under the hood. And again, it has nothing to do with the algos. And, it's funny because I think on CNBC, what they try to do regularly is they try to make sense of what's going on, right? There's the guy, I don't want to call out, who these guys are if you watch CNBC. But every day they try, the market is down because, there was a headline about this. Yes, there are some algos out there that try to capitalize very quickly on the headlines and try to sell and try to beat everybody. There's those algos out there. But for trying to make sense of every little headline, I think it has more to do with institutional funds are not accumulating anymore. They are selling. So I think that it's a good point to bring up because these are the big guys, right? The retail stuff is not going to, if you're out there and you're buying calls on a couple things or you're buying shares, when a big hedge fund has a couple $1 billion to sell because they're being liquidated, you're going to get run over. And that's the environment that we're in right now. So I don't know anything about these hedge funds. I don't know when, if any more have to liquidate or if any more or are stressed right now. So I don't know any of that. I don't have a crystal ball, but that's what's going on right now. And, considering those guys are the big guys in this market, to me, it just says to play conservative until that's over with. Right. And I think that so you kind of put together these pieces of the puzzle, that these hedge funds are closing. Again, not every hedge fund. I'm just, I'm not trying to be dramatic. But that's going on. You could see from the price action that every time, wherever we open, a lot of things are going much lower, especially riskier things are going much lower from the open. So the bottom line is that basically tells me to really watch how you're positioning, and you want to be able to weather this storm. And that's not by taking a lot of risk, in my opinion. It's by, trading very small and just trying to get through this for as long as it takes. It could be a couple days, could be a couple weeks, could be a couple months. No idea, right? How long that this is going to take to kind of, as an investor, to get through. All right, so that's today's video. But please, the high frequency shops use algorithms and they will kind of front run and they will exploit. But please do not think it's the algos that are doing all of these moves that are really causing this, causing these liquidations. That is not how it works. And if anybody has any questions, they can email me. I'm happy to discuss this. Listen, I traded institutionally for a long time. I traded in the middle of some of the worst, times in the financial markets. Were there algorithms that were making it harder? or high frequency guys harder to execute trades when you had a big order to sell? Sure, the market kept on slipping, every time that you wanted to sell, but they're not the root cause of the issue. And trust me, I had to do a ton of selling, back in 2008, 2009, when the market, every day was kind of doing what it's doing right now. So that said, that's the message for today. So, I'm not real. There wasn't that much call activity to kind of really go over, but there was a big roll down of Citigroup, which I mentioned that one already. There was I don't have THC in here. THC was there was a lot of trades that went up. I don't know if they were unwinding some of their January 22 calls. Big open interest on these. They may have been rolling those out, going into January 2020 in THC. Um, Other than that, just a lot of two-way index flow. Again, I would say maybe a little bit more to the short side. All right, guys, that's it for today. Have a great night. See you tomorrow.